26 questions about valuation that I received from my March 30th, 2022 presentation to CFA Society New Zealand. These were excellent questions, and I'm going to try to answer them quickly through these 26. It comes from my presentation on 9 valuation mistakes and how to avoid them. Let's get into the first question. The first question was, what is the impact of rising interest rates on the equity risk premium? Well, you know, I always tell my students to think of the cost of equity like a pizza. It doesn't matter how we slice it. What matters is the end result, and that is the cost of equity. We could be right, we could be wrong on the risk-free rate, on the beta, on the equity risk premium, but if we get the discount rate, the final cost of equity wrong, we're dead. So my answer to this is I'm not too worried about all that. What I'm worried about is what's happening with the cost of equity, and in this case, I believe the cost of equity is rising pretty substantially right now because interest rates are rising, risk-free rates are rising, premiums are rising, stocks are getting riskier right now. They're a volatile asset class, so cost of equity naturally is going to arise or rise. Now, the problem that we face is that we have had a bull run of more than 10 years, and so it's very possible that what we see over the next, let's say, 5 years is a very low average annual return in the stock market. Let's say 5-6% maximum that we could get on average over the next 5 years because we had such an amazing bull run. If that's the case, then it's going to be the equity risk premium that is contracting. Let's go to the next question. Question is, how do you quantitatively incorporate ESG in valuation? It's very difficult. You know, I have a different view on ESG. One of my problems is that really the environmental protection of our world and of our countries and of our cities is up to the obligation of the citizens and their government. And I think ESG has a dangerous, dangerous precedent of outsourcing this to the private sector. But anyways, let's talk about ESG. The question is, ultimately, if the company is doing the right things relative to the environment and relative to the society as a whole, it should be already in the price or in the valuation. I would argue that you don't need to put a huge ESG in there. I would look at an ESG component more as a negative list. If they don't score this high on social, then I won't. But be very careful. There's a game going on with ESGs. When you have companies like BlackRock saying that they have to have ESG and do all of this, that is going to give preference to the large cap companies, the companies that can afford an ESG team and all that. Smaller companies that may follow all environmental laws will be penalized. Be very, very careful. Large companies and highly profitable companies will end up with high ESG scores. And the highest ESG score is not really the ESG, it's really correlated with the size and the profitability. That's my different view on ESG. Let's look at the next one. How do you value pre-revenue companies? I have a whole presentation, which I'll put a link to right up above here, and that presentation is about pre-revenue questions that you need to ask. And the point about pre-revenue, from my perspective, is that you can value an idea. I call that idea. You can value activity, let's say downloads of a free app, and then you can ultimately start to value revenue. That's where valuation starts, in my perspective, for pre-revenue companies. How good is the idea? There may be value. And if on my team is Elon Musk, our idea could get a lot of cash. So ideas have value and activity has value, and ultimately they translate into revenue, which eventually translate into profit. So look at the idea and what you think is the value of the idea, and look at the activity. Next question. How do you consider the sustainability of high return on invested capital companies? This is a challenge. Many analysts make the mistake, all of us, when we forecast, is that sometimes what we're doing is we're just saying that a company has high return on invested capital now, and therefore it's going to have high forever. It's impossible. The world is just too dynamic and competitive. So what you have to expect is that profitability will fall. What I've learned in my experience and from my academic style testing is that ROIC won't fall to average. In other words, they'll always have a premium ROIC unless the company blows up. Same thing on the downside. I found that dogs remain dogs. So you may adjust up the ROIC from a very low level company up, but I wouldn't adjust it up to average. So that's how I handle it. I fade it down in the fade period. I have a discrete period of 5 years and a fade period that's anywhere between 3 and 10 years, depending on what I put into my model. Next question. How do you value fast-growing companies like Tesla? It's an exciting thing to value, really, Tesla. And I would argue that really the Tesla story, when I look at valuing a company, I'm looking at stories. What stories? Number 1, revenue. Number 2, cost of goods sold. Number 3, expenses of the business. And number 4, capital. Those are the 4 main stories that we look at. So in the case of revenue, as in the case of Tesla, the question needs to be, is this a price story or a quantity story? Clearly, Tesla is a quantity story. They've got to roll out those cars. You're not going to be able to increase the price of electric vehicles by that much because it's a competitive space. So it's clearly a quantity story. Take a look at Meta or Facebook, and what you can see is that it's a price story. They've already got maybe 70% of the world's users. So they don't have a lot of upscale or up potential on quantity. So then the question is, what's the price they're getting from the average user, and can they get more? Right now, Meta's getting a very low amount for people in Asia, but they're getting a higher amount for people in the US. Can that translate into higher from Asia? It's all a price story. So once you've identified it, whether it's price, cost of goods sold, expenses, or capital, then focus in on that area and see if they can do it. All right, next question. What's the appropriate terminal growth rate? I generally say between 0 and 5%. If you're growing a terminal growth rate more than 5%, it doesn't make sense. Remember, the whole purpose of the terminal growth rate is to simplify our valuation. If we really wanted to be technical valuation, we would forecast the cash flows of the company to infinity. But that would be ridiculous because we can't even forecast 1 year ahead. What about 50 or 1,000 years? Doesn't make sense. So we're going to have a discrete period, a fade period to make sure we get down to kind of average profitability, and then we're going to use the constant growth model to do the terminal growth rate. And I would say that at that point, I use between 0 and 5%. Next one. How do we value assets in emerging markets with unstable foreign exchange rates? Perfect. I love this question, and I faced this a lot when I was head of research and as an analyst. And basically, my conclusion is first thing you have to do is remember, you're making 2 investment decisions. When you're investing in your home market, you're making 1 investment decision, and that is, what is the value of this underlying asset? But when you're investing in another country, let's say Thailand, you're going to say, okay, what's the value of the underlying asset, and what do I think is going to happen with the exchange rate? These are 2 separate things. So my answer to this question is focus on local valuation of that company. If you're looking at a company in Thailand as an example, use the local interest rates, use all the local factors and say, this is what I think that this company is worth in this local market, and then make your adjustment relative to what you expect with the foreign exchange of that country. And I separate the 2 so that we get clear on the valuation. Also, it's a great way to remember that majority of the people are locals that are valuing that company. So if you start to put in some weird discount rates, then you're going to find out that you're just way off. So separate. Next question. How does valuing a REIT and a property developer differ? Well, a REIT is kind of like a bond. It's just providing a certain amount of yield. And so I would say that a REIT is a more simple type of thing to value. And also, what's also interesting about REITs to me is that they're contractually priced, and those are long-term contracts. So it's difficult to raise or lower price for a REIT, whereas for a property developer, it's just a typical manufacturing business. And so it has a lot more flexibility in the structure. And therefore, you have to consider that also property developers tend to be more risky than a REIT. So I would just look at them as 2 very different businesses. One is like a bond, and the other is like a manufacturing company. The next question is the Warren Buffett view of discount rates more appropriate? Now, you'll notice I have a number after each one of these. That number is the number of upvotes that particular question got. So what is the Warren Buffett view? Well, let's just look at this for a moment. Here, I found on the internet from a 1997 Berkshire Hathaway shareholder meeting, Buffett said, we adjust by simply trying to buy it at a big discount from the present value calculated using the risk-free interest rate. So if risk-free interest rates are 7% and we discount it back at 7%, then we'd require a substantial discount from that present value figure in order to warrant buying it. All right, so let's try to answer this question. I want to tell you a story. My uncle lived in Germany, and he worked on the military base. He was a logistics guy, and he had the commanding officer come to the military base, and basically the commanding officer came from the U.S., came to the military base for an inspection. They had been cleaning and making the place tip-top shape. At the end of the whole inspection, they ended up in the yard where all of the trucks are. You can imagine all of the huge semi-trucks, small trucks, Jeeps, all of that. And when they stood out and they looked down the line at all of these vehicles that were parked side by side all the way down the line, my Uncle Ham said to the commanding general or the commanding officer, "So, sir, how did you like our situation here? How do you like our base?" And he said, "Ham, everything was great except one thing." And he said, "What?" And he said, "Next time, can you line up these cars properly?" Well, what Ham saw was because he had different cars, some of them were sticking out in trucks, they were sticking out in different lengths. So my Uncle Ham took the commanding general back to the back end of the cars to look down because my Uncle Ham had lined up all the cars on their back bumper in a line. So their front bumper was in a very separate way, and they all looked different coming out because all the vehicles were of different lengths. The point that I make of this, that Uncle Ham said to him, "Do you want me to line them up on the back or on the front?" The point is that in some ways you're going to have to make adjustments whenever you're valuing a company. Where are you going to adjust it? Warren Buffett does not adjust it in the discount rate. Done. He just picks that discount rate that's the risk-free rate. Done. He doesn't mess around. So where does he adjust it? He adjusts it in its cash flow. He adjusts it in the discount that he wants to see. And so I would say that I wouldn't necessarily follow Warren Buffett's way. I would say that but I do like the fact that he tries to keep it relatively stable. Just take a risk-free rate and add a little bit of premium or discount depending on what you think is the riskiness of that company. Do not get so complicated on the CAPM and all of that stuff. All right, next question. What is your process for getting comfortable with multiple-based valuations? Well, it can be extremely hard when multiples are super high. The question is, can this company drive this earnings growth going forward? I think Tesla is an interesting one where I feel relatively comfortable about the valuation because they are delivering. And once you go and see that they're delivering by opening up these factories and they're able to get these cars out, once you start to see that, you start to realize these guys are really going to be able to deliver on that. And as a result, I feel comfortable with the multiples. That's one thing that I think about. Now, next one, is it still a thing to consider the convergence of market price to intrinsic value? This sounds like coming from a value investor who has been crushed over the last 5 or 10 years because value investing hasn't worked. That conversion hasn't worked. I would say over the long run, it is going to work. But hey, if you're focused on a style like value investing where you're trying to buy something at a deep discount and hope that the share price is going to converge to the intrinsic value, there are times that style of investing just doesn't work that well. I try to solve that by using a style of investment I call FBMR, where I look at fundamentals, valuation, momentum, and risk. But, some people decide that they just want to be focused on that one measure. And I would say that it could be periods of times that it doesn't work, and then eventually it will come back. How do you incorporate a looming recession and uncertainties around interest rates into your valuations? I do it through, there's two ways to do it. The first way is through the cash flows. I like to spend all of my time focused on getting the cash flows where I think that they're going to be. That's the first part because that's the key. Then there's the discount rate, and that's where I just start to make adjustments based upon what is the riskiness. You could see that interest rates are super low right now, but you may think that there's a huge amount of risks out there, so you may value at a deeper, at a higher discount rate. Let's go, how do you quantify qualitative strategies in model building? It's very difficult. I think, in fact, this sounds like a CFA charter holder, an analyst type of person. We want to quantify everything. But, how do you quantify the value of a hug? There are things that just aren't meant to be quantified. So I would say, look at your qualitative factors and build your ideas and your stories around that. And don't feel like every qualitative factor has to be mapped into some quantitative thing. That's just my opinion on it. Other people may feel differently. Next one, would you consider playing with a time-varying beta with time-varying discount rates? Yes, absolutely. In my value model, which I use in my valuation masterclass bootcamp, students get access to my model that I use, and it has a time. You're able to change the beta. Why is that significant? That basically what you're doing is you're changing the weighted average cost of capital. I don't change the cost of equity. I just leave that flat, same throughout the whole period of time. But basically, we know that the capital structure is changing because I use a 5-year discrete period. So the capital structure is changing over that time. So I'm okay with changing the interest rate, the structure of the debt, and the beta over time. But just be careful not to go too crazy. I remember a company in Thailand many, many years ago that was a real distressed company, but it started to turn around and they started to rebuild the cash flows, and then they started to pay off that debt. If you didn't have the flexibility in your model to compensate for a changing weighted average cost of capital, you may have mispriced it. But most of the time, a weighted average cost of capital, an average one, is enough. So that's what I would say. Next is, do you cross-check your DCF to multiples? I wouldn't say I cross-check and that I really officially do that, but I definitely try to understand, okay, this is what I see from a discounted cash flow basis, this is what I see from a multiple, and then I've got to make a decision. I think most of the times what happens is that you end up relying on one or the other. There's a fallacy called the middle of the road fallacy, which basically says that when you have two opposing ideas, let's say you're valuing the company at 100 by DCF and 200 by multiple, you could say, well, I'm just going to choose 150. No, actually, the distance, the choice of 150 in the middle does not mean that it's the right decision. It may be that it was worth 100, or it may be that it's worth 200. Let's look at the next one. Next one is low interest rates should matter should low interest rates matter as the duration of an investment is only 15 years, even though it goes to infinity. Okay, this is a question that came up because I talked about the fact that be careful about low interest rates, because if you put in super low interest rates, you're forecasting to infinity, and then what's going to happen is that you're going to, the nearer term periods have a much higher weight. So if we have a very low interest rate environment for the next 5 years, that is going to have a high weight in the valuation because it is the next 5 years. And all those future years, because of the duration basically, and because of the present value of those is just less and less the further you go out, have less meaning. I agree with that, and I think that this is a good point. But I also would say never underestimate the fact that things could change dramatically. It was only a year or so ago where people wouldn't even have expected that interest rate would start to rise, that inflation would go up to 5, 6, 7, 8%. Nobody thought that at that time. So I would argue that just because interest rates are low today, it does not mean that they're going to be low next year. And if they're low next year, all of a sudden, it's a different story. So what I would say is try to focus on averages. Try not to get too committed. This is another bias we call recency bias, where you're looking at things and you're applying whatever you're recently seeing, such as very, very low interest rates. Next question is, how best to calculate WACC, weighted average cost of capital? Well, I think the first thing you really got to do is make sure you get your cost of equity right. And as I said about the pizza slice, basically, weighted average cost of equity is just using the capital asset pricing model. It's like slicing pizza. Don't get too hooked up in it. Remember, what's the risk-free rate? What do you think the riskiness of the cash flows of this company are? You could look at discount rates in relation to the rate of return, like 10% over the long term in the U.S. as an example, and then consider what discount rate you would want. So then when we get to the weighted average cost of capital, then you apply that equity, that cost of equity, and then what I would say is the biggest issue that I would see is that you want to make sure that a company that doesn't have any debt or very little debt, over long term, they're probably going to add debt over time. So that's one of the adjustments in WACC. But I would say that WACC is pretty straightforward, and make sure, of course, that you're using the market cap weight of equity. The next question is, what are the best or good ways to model or overlay capital structure? Again, this is a little bit about the cost of, the weighted average cost of capital. I think it's okay to allow cost of the capital structure to change how they've been funding the company. And I think that is already compensated in the weighted average cost of capital, and also it should be to some extent compensated in the beta. So if a company starts to go into more distressed situation where they have a higher and higher amount of debt capital, you're going to expect that the interest rate is going to be higher, and you may expect that the beta would be higher because the equity investors are seeing the compensation being required for debt going up. So those are some of the ways that I would think about it. I wouldn't necessarily overlay it, but I would just make sure that you've made those adjustments in the model. The next question is benchmark rate used for risk-free rate. I think from my perspective, we've had interest rates. If you go to let's say Europe and you look at discount rates, we're talking about negative right now. There's no way you're going to use a negative discount rate in a discounted cash flow for stock, because a company's never going to be able to anyways get a negative rate for their bonds. So I would just say that you really want to remember that you're forecasting the discount rate and the risk-free rate. You're forecasting that to infinity. So don't get caught up in recency bias, except the fact that if interest rates, let's say risk-free rate is 2% right now, then nothing wrong with saying, I think it could be 3 or even 4%. We definitely have had that in the past, and it's possible that it could get back to that. We've just been through, obviously, a 40-year down cycle in interest rates, and that's reversing. So things are going to be very different. We're at a inflection point. How do you estimate the expected return on equity? I think, again, I spend a lot of time working on the discrete forecast of the company to try to think about what's happening. Equity in some ways is a good measure, but in other ways it's not. I prefer return on assets when I'm looking at a company, or return on invested capital, because that helps me to understand. Forget about the structure of the balance sheet. That's a different decision. What I want to make sure is that this company is highly profitable and getting the most out of the capital that's been deployed there. So that's how I look at it. I don't look at return on equity that much, but I just build it into my discrete forecast. But I'm not forecasting return on equity. I'm forecasting the growth in revenue, the margins. I'm forecasting the balance sheet, and the return on equity is just a result of that. Next one, how to spot the mistakes when doing a valuation process. In the value model that I use and I teach in the Valuation Masterclass Bootcamp, I use these 9 valuation mistakes that I've come across, and I create a structure in every model that allows us to look at the mistakes it could be potentially making. Now, there's no way that you can have a complete model for finding mistakes, but I would argue that if you have a model that gives you some indication that you're making mistakes, that's what I have in my models, and it's a critical thing. But I would say that the typical analyst is never going to build this into their valuation process, because they just don't cover enough companies that it's worth it. And that's the benefit of doing modeling that I do across the whole world, and supplying it to other people. What's the average gross profit observed in SaaS companies, software as a service? In this case, I would say the average is getting close to 40 to 50%. There are some, that are super high, but let's just look at, as an example, Microsoft as an example, which is, we're talking about 50, 60%. So it can be very high. Remember that the average gross profit margin across all companies, excluding real estate and financials, is about 30%. So we're talking about 10 percentage points more, maybe at 40 or even 50%. SaaS companies are very profitable at a gross profit level, because the cost for developing, you don't need a factory and all that, you just need a lot of smart people. How do you feel about companies claiming that their maintenance capex is much lower than their depreciation expense? Is this credible or sustainable? Generally, I would say no. I wouldn't believe it and I wouldn't trust it. They may say that they don't need to spend so much on maintaining their existing equipment, but my other point is that, what are we investing for? The number one factor that you really want when you're investing in a company is that it's consistently growing its EPS. If you can find companies that are doing that, then you're in awesome shape. So if you find yourself debating about low maintenance capex and low capex, I think you've already got a warning sign about that potential company. Next one is, I think this is the last question. When risk-free rates are very low, how do you keep your cost of equity between 8 and 13%? So my rule of thumb that I tell people is try to keep it between 8 and 13. You can go outside of that, but just make sure that for your cost of equity, you really are more aware when you go outside of that. So it is very difficult. If you say there's a discount rate or there's a risk-free rate of 1%, you could be saying that, really the discount, I could use a cost of equity of, let's say, 5%. The problem is if you use a low cost of equity like that, you are really, really highly valuing the company. And I'll leave you with this idea here in relation to this. Part of the mistake I believe that all of us make is we all fall into the recency bias thing. And what happens when we have recency bias is basically we are keeping interest rates, let's say if interest rates are super low now, we're going to keep them that low to infinity. And that's where you have to break free from the bias of recency, and you need to think more long term. Now you could say, Andrew, well, I could lock in a 10-year bond at 2%, so how can you say that I shouldn't use that low rate? Well, I would say also remember, people don't lock in their portfolios. They roll them over, they reinvest them, they have turnover in them. So it's a little bit less realistic to consider a 10-year fixed bond where they don't do any trading in it. So I look at the average bond rates over time, and I see that there's a lot of variability to it. So don't be too afraid from breaking away from recency bias. Unfortunately, you won't be liked very well because you're saying this company's not worth as much as everybody else thinks. But when things go south, they may like you. This is my summary of all the questions I was asked at this amazing presentation that I was able to attend and get these great questions. If you've got more, just leave them in the comments below. Have a great day.